Hi, good afternoon, and thank you for joining us today for our Legacy Giving webinar. We're so happy you've made the time. If you've made the time to join us today, I'm sure these quotes resonated for you. The first is from famous American poet and civil activist Maya Angelou, and the second is from politician, businessman, and philanthropist Michael Bloomberg, whose foundation in 2020 alone gave $1.6 billion in investment grants to folks in 170 countries. The word philanthropy comes from ancient Greek and actually means love of humankind. In the second century AD, Greeks used the concept of philanthropia to describe superior human beings. So we're so glad you're here and you're ready for this topic. Estate planning and legacy giving fundamentals. I'm Michelle Martinez, and I joined BFHP in July of 2020. I joined as the interim director of finance, and since then, I've moved on and I'm filling the role of director of operations, and I oversee finance, facilities, and IT. I received my MBA with a specialty in nonprofit management from Golden Gate University, and I served as the director of finance at Hospice by the Bay, now by the Bay Health, for nearly 10 years. And most recently, I was the CFO, COO at the Bay Area Discovery Museum in Sausalito. A little bit about BFHP now. BFHP is a very special nonprofit with a long-standing tradition of service. Our mission is to ease and end the crisis of homelessness. We started on this mission back in 1970, and now we are in our 51st year of service. Over the past several years, under the leadership of our executive director, Colleen Egan, we have expanded our programs, our reach, and our impact. And as you can see from the graphic, we are operational in 6 counties, and we deliver a host of many impactful services. Some of our current and future initiatives include currently a large response to COVID-19. We've partnered with local counties and cities to ramp up shelter in place and also expand our meals program for those in need. We just announced a lofty $1 million food campaign to support an expanded community meals program and to pilot a social enterprise venture. And very exciting, we are pleased to announce we are developing new housing. The BFHP Hope Center is opening in June of 2022, and this center will hold a 32-bed shelter, 12 units of transitional housing, and 53 permanent supportive housing units. It will also hold a community center and a large community kitchen where we can expand our meals program. We're also very excited about our Rio Vista Veterans House. We partnered with Habitat for Humanity and opened this in January of 2021, where now 6 formerly houseless veterans live in a community setting. We're also in discussions with our second veterans home with Habitat for Humanity. And finally, as you may know, Governor Newsom has announced $1.4 billion in home key funding, and BHP will be applying for that. Should we be successful, we plan on purchasing and renovating a local hotel property and creating more affordable housing right here in Berkeley. All these initiatives are exciting and they'll positively impact our communities, but we can't do it without you. And so we're very pleased you've joined us, and we thank our donors and staff. Legacy giving is one of, if not the most impactful way that donors can support their favorite cause and nonprofit charity, not only while they're alive, but after they've left this earth. So, what does legacy giving impact look like? It looks like transformation and expansion. It allows us to transform and expand services we're already delivering, maybe expanding the reach. It allows us to have new programs and develop the affordable housing I was just speaking about. It allows us to have enough resources to continue during emergency events like the pandemic we've all been experiencing, wildfires, and earthquakes. And finally, and maybe most importantly, legacy giving can provide much needed stability to nonprofits like ours, as we rely heavily on government funding, and that can be stagnant or fluctuate at times and cause our operations to experience uncertainty. So legacy gifts are a great way for our donors to help us look to the future and meet our needs. We are very pleased today to have partnered with the Bay Area Wealth Management Group to make this presentation. Bay Area Wealth Management Group has graciously made themselves available to our donors, our staff, and of the community to give us advice and counsel on this topic of legacy giving. Our presenters today are Nikolai Papa and Michael Tate. Nikolai earned his bachelor's degree at UC Davis and his master's degree at the University of Illinois. He began his career in the securities and financial world, and he has earned numerous distinctions and awards in his first few years, giving as an advisor to his clients. He's currently pursuing his certified financial planning designation. He is focused on educating his clients and those around him on all financial matters, big and small. He has instructed many retirement and financial planning courses throughout the Bay Area and at Fortune 500 companies. He currently lives in Berkeley with his wife and 2 sons. Also joining us today is Michael Tate. Michael Tate is a certified financial planner and has been in the financial services industry for 28 years. He is a graduate of UC Berkeley, go Bears, and holds a postgraduate degree from Indiana University at Bloomington. Mike is extremely active in community service and has an emphasis on educational outreach. He served as a mentor at Eastside Academy in Palo Alto, and he plans to continue his support for college-bound youth programs throughout the Bay Area. As they're presenting today, we invite everyone to post questions and comments into the chat section, and we will do our best to answer those throughout the presentation and leave room at the end. So without further ado, let's get started, and I'll turn it over to Nikolai. Thank you, gentlemen.
Hi, Michelle. Can you hear me? This is Mike here. How are you doing?
We can hear you.
Yeah, all set. Good. Wonderful. Well, thanks again for having us, Nick and myself. We are Bay Area Wealth Management Group. I'm Mike Tate, and of course, Nick, my partner of 12 years. Really look forward to helping out on this with this endeavor, doing some basic blocking and tackling on estate planning and legacy planning issues, which I think are really at the forefront of our concern with a relationship with you guys at BFHP. Our mission is, I think, important to talk about briefly so you get to know a little bit about us. We are a Bay Area wealth management planning firm. We've been located in San Ramon, California for some time now. But we have been together as a financial planning team some of us for almost 40 years. There are 9 advisors in our firm. Again, Nick and I have been partners for 12 of those years. We manage a little north of $500 million now in client assets. But more than that, we have, I think, a very socially aware strategy. Our philosophy is really based on 150 years of financial planning experience and interaction with our clients. And so I'm thinking, we should just take a little bit about our philosophy. I mean, we are very concerned about the client and the client in mind, and lots of folks say this, but we are definitely committed to it because we're a non-proprietary firm. That is, we don't We don't work for an insurance company or for Vanguard or Fidelity or for any other large institutional house, whether it be an insurance company or a wirehouse. We are independent. We work only to achieve our clients' goals and best interests. And we have, I think, a very socially aware and environmentally sensitive approach to what we do with our clients and indeed with our community service. Both Nick and I are active in that. Our process is fundamentally a financial planning process, but most important in this process, it's an engagement process. It's driven by a financial planning emphasis. All our clients begin this planning process, from goals to data gathering to analysis of the plan, solution development, implementation, and then constant review. We are constantly on a quarterly basis in contact with our clients. And our services are, I think many of you are probably aware of this hard screen to read, so I won't spend a lot of time going through this with you, but we provide many of the menu items that you'll see elsewhere, but in a different way. I mean, we do investment planning, certainly. We manage assets, as I mentioned earlier. We do in protection planning, make sure that legacies are preserved and protected against market risk and other risks. Do current financial analysis for business clients, estate planning, again, for almost all of the individuals with whom we work. Very important these days, retirement planning and tax planning has been an extraordinary emphasis, and that dovetails again with our planned involvement and support of BFHP and your legacy planning strategies. So what Nick had suggested, and I have certainly endorsed, I mean, we would like to be able to share today some basic blocking and tackling, and Nick's going to take over and lead that for us in a moment. But remember, our firm, I think, has a very high social visibility. It's committed to a client engagement process, which is non-proprietary. And if we could be of any assistance in answering any questions today, we're here to do so. Nick, why don't you take it from here?
Thanks, Mike. Thanks, Michelle. Happy to be here with everyone today. Thank you for attending the webinar. We're going to talk a little bit today about just some of the main strategies that we have been helping our clients with over the past couple of years in terms of making these legacy gifts and planning for the most efficient way to make a legacy gift to a nonprofit, be it Berkeley Food and Housing Project or some other organization that you feel very deeply about and care about that mission. Our role as independent advisors is just to take all of our clients' wishes and then try and present them with some of the best possible strategies for not just accomplishing what is important for them, but in the process, if there's a benefit that they can take advantage of for themselves, for their families, by doing something they had already planned on doing, that's one of our roles. So we're going to talk a little bit about some general strategies. There's so many different ways to make these legacy gifts. We really don't have the time to go through all of them here today in the next maybe 20 minutes or so, because I want to be respectful of everyone's time. And some of these different approaches are really, so individualized in nature that you want to talk to someone, a tax advisor, some financial advisor, when you're making these kinds of plans for yourself to really determine what's best based on your individual situation, the situation that you're in, what you see for your future, how you want to be giving a gift to an organization that you really believe in, like Berkeley Food and Housing Project, and what form that gift is going to take. So I'm going to walk you through just some of the most common ways. An immediate way to make a bequest is obviously you can just put a bequest request into a will or trust structure. We don't have time to go through, some of the elaborate trust structures that you could create to really further the effect of one of these gifts. But something to be able to just make an immediate effect and know that you're going to have an ability to affect, the world and these causes beyond yourself is writing some kind of bequest into your will. Something also that we've seen become extremely popular probably over the last 4 or 5 years has been donor advised funds. A donor advised fund essentially is a way to be able to group donations from multiple years that you plan on making into a single gift into a fund that you can then dole money or contributions out of to an individual organization or multiple organizations of your choice. In a way, it's almost like creating a mini foundation. So the reason why these have become more popular in recent years is, after a change in the tax code with the Tax Cut and Jobs Act at the end of 2017, what ended up happening was we saw many clients, especially clients of ours currently in retirement, having it be harder for them to take itemized deductions. So more were taking a standard deduction. For folks who are, maybe you're planning on making a $1,000 a year gift over the next 10 years, a way to think about this kind of planning is to, say, make a $10,000 gift into a donor advised fund, and thus being able to take advantage of an immediate $10,000 deduction, charitable deduction in the current year deduction of the $10,000. You're able to invest that $10,000 inside of donor advised funds so that hopefully that money is growing over the next 10 years. And then you could still, out of the fund, gift $1,000 a year, probably, hopefully more, depending on investment performance, right? Based on how you actually structure the funds inside the portfolio. So it's a way to say, I'm going to take the same amount of dollars I had earmarked for charitable giving, but as opposed to stretching out over a period of time, I'm going to condense these gifts immediately so that hopefully, I get a larger tax benefit. Maybe that frees up extra cash for me to make an additional donation in the current year. Or maybe that just allows me to, be able to take advantage of some investment appreciation in the fund over time so that I can make larger donations over a period of years while still, preserving that tax benefit for myself in the present year. One idea. A couple of other strategies I'm going to walk through, some of the three most common ones that we see our clients making use of. So we're trying to use real world situations here and examples. The first is a qualified charitable distribution. We'll talk a little bit about charitable giving using life insurance, which is something that's often overlooked, but has a lot of benefits, not just for an organization like BFHP, but could have a tax benefit for you as the individual as well. And then we'll just talk about donating appreciated assets and why sometimes that's a little bit more efficient than just donating cash. So when we're talking about QCDs, qualified charitable distributions, these are distributions that you're making out of an IRA, an individual retirement account, in lieu of taking a required minimum distribution. So these required minimum distributions, and there's a lot of acronyms here, I understand, so it can get a little confusing, but those RMDs, minimum distributions that you're required to take, begin at age 72. There's a minimum amount that you have to take out of qualified plans. Qualified plan being IRAs, 401ks, 403bs, pension plans, 401a accounts, any kind of tax preferential retirement plan is going to fall under the structure of a qualified plan that you're required to take a minimum distribution out of, beginning in the year that you turn 72 and every year thereafter. Now, there was a recent change. If you turned 70 and a half, right, before 2020, the year 2020, you had to start those RMDs at the age of 70 and a half. So we have a number of clients that are 71 now that are currently taking RMDs, that required minimum distribution. Now, when you take the minimum distribution, that is taxed as income to you in the year in which you receive it. So you have an IRA or you total up all the value of all your qualified plans, and let's say it's $500,000, for example, right? The IRS is going to have a table based on their life expectancies that says you have to begin taking a set percentage out of that. Starts at around 3.5% of the total value of all your qualified plans, and it goes up every year. So it's a larger percentage and typically a larger dollar amount that you're having to withdraw on an annual basis every year as you age. We have a number of clients who maybe have pension income, maybe Social Security income, maybe rental income, and don't necessarily need to be taking that full required distribution to be able to support their lifestyle. So what that means is that's just increasing their taxable income. Maybe it's pushing them into a higher tax bracket, or just generating a higher tax bill for them in that year for money that they don't actually need to support their standard of living. In that instance, you can use a qualified charitable distribution where you say, I will take money out of my IRA, as opposed to I myself receive it. I am immediately naming a charitable organization, right? I'm saying, okay, I don't need this $15,000. BFHP is going to receive this $15,000. That distribution goes directly and immediately to BFHP in this example. Because you are not receiving the income, it is not taxable to you as income. It does count as meeting that required distribution need. So you are not penalized for not taking a required minimum distribution. And the key here is because you've never received the income, you keep your AGI, your adjusted gross income, lower. This is important because a lot of formulas for taxation flow from AGI. And so keeping your AGI low is typically of higher value than just getting a regular deduction, right? If you were to receive the income, for example, and then write a check out of your checking account or bank, whatever the bank account is, to Berkeley Food and Housing Project, it's actually of less value because it's not affecting your AGI. You get a deduction, what's called a below the line deduction for that contribution that you've made. But what's more important is trying to control that AGI, because so many tax formulas are based on what that actual total AGI number is. This is a way to be able to, if these were funds you were going to be donating anyways, you're able to take advantage of this rule to be able to control your AGI, and maybe that flows into some other benefits for you further on down in the tax return. Now, one of the keys here is you can only use this strategy with distributions coming from a traditional IRA. So if you still have funds that are at a 401k, an old company 401k, or an old 403b, you cannot do a qualified charitable distribution out of those plans. This is only allowed for RMDs coming out of an IRA. So most of our clients end up doing is consolidating to IRAs after retirement, in part because it enables you to be able to use this strategy. Now I want to talk a little bit about charitable giving using life insurance. This is often overlooked, and there's a number of ways that you could actually structure this. We're just going to look at the two most common ways folks will leverage a life insurance policy. The first is you may have a life insurance policy, maybe it's an older policy, and you can just name an organization as the beneficiary of that policy. So you're going to say, I want the death benefit on this life insurance policy to be payable to, as opposed to dependents or a spouse, because maybe there's enough assets and they'll be well taken care of after I'm no longer here. But I want the money to go to Berkeley Food and Housing Project or some other organization, or multiple organizations, right? You could name multiple beneficiaries on these life insurance policies. In the event that you do name a charity as the beneficiary on a life insurance policy, the death benefit from that life insurance policy is included for tax purposes in the calculation of your total estate, just as a death benefit from a life insurance policy always is treated. But you get an equivalent tax credit for that tax-free death benefit that's going to offset the calculation of that for estate tax purposes only. It's not an income tax deduction, it's just an offsetting estate tax charitable deduction for whatever the proceeds are that are received by the organization. Why would someone do this? So we see a lot of clients who maybe had old life insurance policies, maybe their parents got them for them, or they've taken them out so long ago. They're permanent life insurance policies, whole life policies, universal life policies that have maybe there's what's called a paid up death benefit, where the policy doesn't require any additional premium payments whatsoever. Maybe it's $25,000, maybe it's $15,000 or $10,000, and we have clients come to us all the time saying, I don't really need this policy. I'm thinking about just getting rid of it. What should I do? If someone has any kind of testamentary intentions around, an organization that they truly believe in, this is a great way to be able to leverage the value of something that's maybe not costing you any money, but could make a really large difference for an organization that you care deeply about. Now, the second way that we see clients, leveraging these life insurance policies for the benefit of legacy giving is by donating a policy to an organization. So in this instance, the individual would say, I'm not just going to name Berkeley Food and Housing Project as the beneficiary on this whole life insurance policy. I'm going to donate the policy, right? Because maybe there's some cash value inside the policy as well. Maybe there's a, $5,000, $10,000 of cash you could have access to inside that policy. In that instance, what ends up happening is the individual will get an immediate deduction for the lesser of what's called the fair market value of the policy, which is typically going to be how much cash you have access to inside of it, or whatever the basis in the policy is. And a cost basis in a life insurance policy is usually going to be calculated as the cumulative amount of premiums that have been put into that policy over the years. So maybe there's $7,000 of cash in the policy, but over the years, the premiums totaled $10,000. The deduction that you would get in that instance would be for the lesser of those two numbers. There would be a $7,000 deduction. Maybe the death benefit is $25,000, for instance, but your immediate deduction would still be that $7,000 fair market value of the policy. Now, for policies that require additional premium payments, you're still having to pay into them. You can get an additional tax deduction there. And the better way to do this is, as opposed to you yourself continuing to pay the life insurance company, you end up paying the organization, donating to the organization an amount of money equal to those premium payments so that you get the full value of that tax deduction. And then you let the organization pay for those ongoing premium payments. In this way, you can still retain the full cap on those charitable deductions, which I think is about 60% of your AGI. If you're making the premium payments, then the cap is a little bit lower. It's about 30% of AGI. So we just always want to try and make sure people are preserving, as much benefit as they possibly can, in part so that it frees up additional assets for yourself, your loved ones, but also just so that if you did want to make additional gifts, you're going to be incentivized to do so. So the last thing I just want to cover really quickly here, and then we should be able to have a few minutes to go into any kind of Q&A if there's any questions about anything that we've talked about today, is donating appreciated assets. An example of any kind of asset you could donate would be stocks, bonds, mutual funds, real estate, any kind of asset that's appreciated. Obviously, you want to be checking before you make a donation of an appreciated asset with the organization to make sure that they have a structure in place and that they're actually able to receive those kinds of assets. Right? I encourage you to reach out to the organization first to have that conversation. But any kind of appreciated asset you could donate in kind. And the idea there is, if you look at comparing the cost and the relative value of donating an appreciated asset versus selling the asset first and then donating the proceeds of that sale to the organization of your choice, it is almost always a better idea to donate the appreciated asset from a tax planning perspective. So I have a quick example on the slide that we'll just walk through. And this is an example of stock that was purchased years ago and has appreciated in value from $1,000 to $50,000. So you've got a $49,000 gain in the position. right? And you're going to look at donating the stock versus selling the stock and then donating the cash. So in this example, if you were to liquidate the position, you're selling the stock and you're going to donate the proceeds of that sale. Well, because you have a $49,000 gain that you're going to realize, you'll end up owing capital gains tax, right? Which we can just assume maybe that's maybe that's a 20% number, for example. Now, legislatively, there are talks to potentially raise that number depending on your income thresholds. So we don't know what this example would look like next year, but this year, I'm going to sell $50,000 of stock and I realize a $49,000 gain. I've got to pay maybe a 20% tax on that. So we'll call it, $9,000. So I'm left with $41,000 that I can then donate to the organization. Now, my other alternative is donating just the full donating the actual stock itself, right? All the shares. In that instance, the organization is receiving the full $50,000. I've saved myself $9,000 in capital gains taxes because I haven't realized any of that gain. And I'm also getting a higher tax deduction because of the value of what I've donated. I'm getting a $50,000 deduction off of my income taxes versus a $41,000 deduction. So I've saved money up front in the capital gains taxes and on the back end, potentially, depending on your tax situation, in having a higher relative deduction as well. And for individuals who say, well, we have a lot of people who would love to take advantage of this, but they are holding on to a lot of appreciated assets to be able to gift to heirs or other beneficiaries because they know they'll end up getting a step up in basis in those assets upon death, meaning that you can donate money, you can donate appreciated stock, appreciated assets to your children, for example, and they will inherit a cost basis that is equivalent to the fair market value upon the date of your death, as opposed to that original $1,000 cost basis that you may have had. But the example here, this last bullet point, is to look at a strategy where you're utilizing the cash saved in capital gains taxes and from that deduction that you were able to get, trying to leverage that into purchasing a life insurance policy, maybe equivalent to $50,000, equivalent to the value of the asset you just sold, so that will end up going to heirs. Life insurance death benefits are always paid out income tax free to the heirs. So the heirs would still have the same economic value as though you'd never donated the stock. You're able to leverage that appreciated asset for the benefit of the organization, and then possibly still have some additional tax benefits left over for yourself. So just a couple of really quick examples in terms of what we see our clients actually utilizing in the real world over the last couple of years. I want to open everything up now to some questions. Michelle, I'll turn everything back over to you.
Thank you so much. That was very interesting. Tip of the iceberg, really, on how to do legacy giving and understanding how it can really be a win-win, a financial win for the donor and their heirs, and then certainly a financial win for the nonprofit and charity that you might desire supporting. So really interesting strategies. I know there's a lot more to talk about. So there are some contact information on the screen now, and I'm looking at the chat, and we do have a question. Either Nikolai or Mike could take this one. And the question is, when can I start thinking, or when should I start thinking about putting a legacy giving plan together? What's the right age?
Well, I'll just jump off real quick. First of all, I'll say, Nick, I think Nick covered some of the really important basic blocking and tackling. Just to reemphasize, what Nick spoke to is what we actually see in our day-to-day experience with clients. So it's There are a lot of other sophisticated strategies and we can talk about, but those are the ones that really count. When you should start thinking about it is integrated with an overall plan. I can give you a range. I mean, we talk about financial planning from people who are in their 30s to people in their 80s. And essentially the estate planning component is really a portion of the financial planning engagement, which in the entire project in which we've embarked with our client partners. So it's not the question is a right age or an optimum age. It's just, when do you want to start planning? When do you want to start putting, your financial affairs in order? Priorities are always different. Obviously, the priorities of a 30-year-old are not the priorities of an 80-year-old. However, the overwhelming requirement is everyone should have a plan. And we want people to have a plan, have it quantified, make sure that it's something that's workable, feasible. We can maintain it, we can change it, we can grow it together. So there is no optimum age. It's but I think it's an opportunity to do planning at any age in which the estate planning component will always be a part. I hope that's not too long, but Nick, you can clarify more.
No, that was great. I think that was perfect. I don't have much to add there.
We have another question, and this is about charitable annuities. And so the question is, I believe, is BFHP thinking of offering a charitable annuity so that as a donor, I would get X percentage back until death from my gift today? So I don't know, can you address maybe quickly how a charitable annuity works?
Yeah, these are very popular strategies, very popular strategies. You see many nonprofits engaging in using these, and certainly BFHP would be eligible to do so. This is kind of a plain vanilla strategy in which a annuity contract is purchased on behalf of the client as the annuitant. You after you've made the contribution. And there are, of course, the immediate tax benefits of having made that gift. And then the additional benefit of a lifetime income. And all these contracts are different. We depends on which contract the firm endorses or is going to use. But part of our job, Nick's job and my job, is to evaluate these contracts and talk about their actual benefits and costs. But as a giving strategy, it is one which is pervasive and highly valuable to anyone who's going to think about the necessity for guaranteed income as well as their charitable intentions.
Yeah, the only thing I would add there is as an overall strategy, over the last year and a half, they've fallen somewhat out of favor just with the decrease in interest rates, because typically these are going to be fixed annuities and there's going to be some kind of interest rate component that's tied to the calculation of the income payment to the individual who's purchasing the annuity. So my guess would be that as interest rates begin to go up over the next 2 to 3 years or so, they're going to go back to exploding in popularity. That would be the only extra comment I have there.
Thank you. We have another question, and that is, what if I chose to spread my gift out across multiple organizations?
Yeah, you could absolutely do that. I'll speak to that really quickly. With any of the strategies that I outlined, that is possible. So, if we think about the easiest way to do it, it's obviously with a donor advised fund where you're able to lump contributions that would be made across years into a single year. And then from that fund, you have complete flexibility in terms of how you're paying those contributions out over time. But any of the other strategies work similarly. You could name multiple beneficiaries on a life insurance policy. If you're donating appreciated assets, you could donate appreciated assets across a number of different organizations. And I would say that that is the modality that we see at least our clients engaging in any of these legacy planning strategies. Is, no one individual is leaving all of their money to a single organization, quite honestly. All of our clients, have maybe 2 to 5 organizations that they just care deeply about, and they're structuring their legacy giving appropriately across those organizations.
Yeah, I would say that Nick's introduction of the donor advised funds is an important consideration there. It's so much logistically simpler to do that, to get those group those donations together in a one lump sum, as Nick pointed out, and then over a period of time, you can assign any distribution to any one of the particular institutions or entities that you wish to benefit.
Thank you. We have at least 2 more questions I think we can squeeze in. This is a really good one. What if I set all this up, but then I change my mind?
Yeah, so there's, I can speak to that really quickly. Again, everything that we've discussed here, you are able to change your mind, with the exception of, gifts that you're making, right? After you write the check, obviously it's a little too late to change your mind. It's same thing goes with donating appreciated assets. After you've made that donation, that's a final donation. But we haven't discussed any kinds of, more complex kinds of legacy giving, where you maybe have different kinds of trust structures that are potentially irrevocable. There are ways to set up that kind of gifting, where within a trust structure, the decision would be irrevocable. Can't take it back at that point. But we didn't discuss any of that. So everything we've talked about, is very
a gift has to be recognized and received to be acknowledged by the Internal Revenue. The IRS mandates recognized and received. So gifting must, if it's a gift, it's an outright gift. The gift is a gift. It must be recognized and received. The other strategies that Nick points out, there are charitable remainder trusts, charitable annuities. So there are many trust solutions which also must be most of which are irrevocable and to meet the IRS requirement. And then on the life insurance side, when you're gone, then the benefits get paid. You can't revoke it then. I mean, there's no revocability after that.
Understood. So back to charity annuities. And I will frame this as non-specific, but usually are the returns that folks see with charity annuities better than the returns that they could get just outside on their own?
Well, let's be perfectly clear about the annuity idea. Annuities, no matter how you slice them, no matter who offers them, whether it's in conjunction with a charitable gift that you're going to make, as we're talking about now, or in any case, and even if you're not, annuities are only about one thing. It's called guaranteed income for life. Simply put, an annuity is an insurance product that guarantees income for life. They could be structured in many ways. They could be based on market performance. They could be based, as Nick pointed out earlier, on fixed rates. But they are only about one thing. No matter how they're built or advertised or funded, they are about a promise to pay you for the rest of your life an income stream to yourself and maybe to your spouse, if you so choose. So that's all annuities are. So it's not about return so much as it's about income need. Annuities should be evaluated on the basis of how much guaranteed income do I need? In the charitable space, not only will you be getting guaranteed income that you need, but you're also be getting the tax benefits of the contribution. Then the final caveat, remember, although they may be talked about a lot, annuities are not primarily investment vehicles. They use investment strategies internally to boost return or to achieve certain rates of return, but they are not investment vehicles. They are not brokerage accounts. They are built solely to provide a way of guaranteeing an income stream at a certain age to yourself, the owner, or the annuitant. So when you look at this, look at it in terms of income stream or cash flow analysis. Nick, what do you think?
That's you took the words right out of my mouth. That was exactly what I was going to say.
All right, we have time for one last question, I think, and I think I know the answer to this one, but I'm going to let the experts field it still. And that is, what are the potential tax changes on the horizon, and could they affect my strategies?
You have about 3 hours. You have 3 hours to go.
Yeah, we're going to extend the webinar for at least 2.5 hours.
Yeah, well, you hear a lot, and our internal people, and the folks we work with, on the other side of the business, the internal house to houses, the specialists with whom we consult, the market reports, which Nick and I evaluate every day. You really don't know. We only know two things. We know that there's going to be an enormous demand for increased revenue. That goes without question, given whatever the present political environment may determine. Nevertheless, there are going to be expenditures that have to be made on infrastructure and, of course, on projects driving social change, as President Biden has outlined. And that's going to cost a lot of money. No matter what passes, it's going to cost a lot of money. So there are many, many, many ways in which the committees are going to be considering how to raise that money. There probably will be increase in tax rates. Marginal tax rates will increase for certain individuals, especially individuals making over $400,000 a year. Capital gains rates will increase. How much? No one can say. It's kind of an art negotiation. Estate tax exemptions may change. Again, we don't know what exemption limits might be reset, but I can tell you that Nick and I, we have to do what you call preventive, financial planning in this arena. The best thing to do is get with your advisors, start looking at the tax efficiency of what you're doing, and then for every individual thing that you're doing, measure the tax efficiency under present law and what the potential changes might be under the new law, given the quantitative differences, so that you have really something to talk about. And that Nick and I do that on a regular basis, and I hope you guys and your advisors are doing so as well.
Thank you. Excellent advice. Well, with that, I think we're going to go ahead and wrap it up. I'd like to thank our presenters, Nikolai and Michael. Thank you for joining us from Bay Area Wealth Management. On the screen, we have contact information for both BFHP's Donation Legacy Giving Team, as well as Bay Area Wealth Management. So if you have further questions or wish to follow up with us, we're happy to entertain your questions and happy to hear from you and work with you. And thank you so much for your participation. We hope you enjoyed this session and learned a lot.
Thank you.
Thank you, Michelle. Thanks to everyone who attended.
Take care.